Good morning, everybody, and thank you for attending ETF Build's webinar on the future of innovation and what's next for ETFs. We appreciate your interest. By way of background, ETF Build project was started about 5 years ago amongst myself, Richard Curie, and John Jacobs, who's on the panel today, Bib Stretch of Thompson, Hine, who's helping us with the webinar as well, and Justin Mice of Buttonwood Communications, excuse me. We put this group together to get information out to the industry professionals about what's happening in the industry. It's a large industry. It's dominated by a few major players, and we want to lead discussions around what's happening in our industry so we can stay updated what's happening and maneuver ourselves around this ever-changing, ever-growing industry that we are a part of. So thank you very much for being a part of it. Before we begin with introductions and everything else, I do want to take a moment just to recognize yesterday's anniversary of 9/11. Very difficult day for a lot of us personally and for the country and for this industry. But at the same time, it showed the resilience of the American people. It showed the resilience of our capital market system and how we got everything back up and running so quickly, and how we continue to be the envy of the world in the size and scope of our capital markets. And I like to everybody be remembered, not just on the anniversary, but if we can remember them every day. So with that, if we could just take a moment of silence in memory for those that were lost. Thank you. Great, thank you. I appreciate that. Now, just real quick to get into introductions. My name is Richard Curie, a co-founder of ETF Build. I also run an ETF consulting business called Global ETF Advisors, and recently was named Entrepreneur in Residence for Blue Finance at the Center of Innovation Entrepreneurship at University of North Carolina, Wilmington. And if you can indulge me for a second, I do want to give a little shout out over there to the university. Project that we're working on, we are going to announce very shortly the establishment of a new index, a big investable large cap index for the industry. We're just waiting on some contracts with our calculation agent before we can make the announcement, but we're ready to go. And FactSet was our partner in helping us to build this index. But the university has also created a class. And if we're going to talk about the future of innovation, the future of our industry, it starts in the classroom. So there's a number of students who are on the call today, as well as the professors teaching the class on blue economy and indexing at UNC Wilmington. So just a shout out to all of them for their interest and their participation, because they are the future of our industry, and I appreciate their interest as well. So thank you for that. So let's just go around the table here for introductions. Alex, why don't we start with you?
Sure. So I'm Alex Matturri, and until 2020, when I retired, I was the CEO of S&P Jones Indices. I was there from 2007 to 2020, so I think kind of the golden age of index providers. And prior to that, I was involved as an index portfolio manager and trader and strategist at Northern Trust, Deutsche Asset Management, and earlier than that, as a derivatives trader at Bank of New York. So I've been in the industry for probably way too many years now.
Great. John?
Thanks, Rich, and welcome to the UNCW students. As a Maryland Terrapin, I have mixed emotions about this, but that's okay. We'll get through it. So I was at I was 30 plus years at NASDAQ and did a lot of things, including running their index business and data business, et cetera. Since then, I've actually been affiliated with Georgetown. I'm on the board of VettaFi, an index data and digital distribution company, a bunch of ETF boards, et cetera, and some other things in the digital blockchain space. So just really excited to be here today. So thanks, Rich.
Ira?
Thanks, Rich. I've been in the ETF industry before there was a word for ETFs. Going back to my days as a lawyer at Merrill Lynch, when Barclays Global Investors launched iShares and in effect created the ETF industry that we know today, I joined Barclays Global Investors as the first chief legal officer for the iShares business. And I served in that role for almost 10 years before Barclays was sold to BlackRock. When BlackRock acquired the business, I moved into a business role. I was the head of product strategy and product development from 2011 to 2017. Since then, I've been an independent consultant to the industry. I've worked with a number of large firms looking to get into the ETF business and think about their ETF strategy. And I'm a director of an ETF startup and a small index company.
Thank you. And Reggie.
Reggie Brown. I had the good fortune of being an early market maker of the first unit investment trust called SPY on the American Stock Exchange, which now is owned by the New York Stock Exchange. I've seen the growth of the business, entry from SPY to QQQ to the MDY, midcap, and then a bunch of sectors, and then everyone else that came in behind that over the last 30 years or so. So currently, I run an ETF market making business in the US, and then I also chair ETF fund board as well.
Great, thank you. One quick housekeeping note I forgot to mention. There is a Q&A section here for you to enter questions. We may be able to get to them. If we don't, we will print them out, answer them, and email them to all participants. So you will get answered those questions even if we don't get to them today. So please feel free. And I think as you can tell, the depth of experience of the four gentlemen on the panel, they were at the forefront of innovation at the beginning of this industry. They continue to be at the forefront of innovation currently in the industry. So their perspectives on everything is great. And as we talk about the future of innovation, the future of our industry, I want to take a moment just to kind of take a look back at where we came from with a little bit of the history of it. And I think, John, you're a great person to kind of lead us through a little bit of where we came from so we can start the discussion about where we're going.
Well, any one of us could do this history, but yeah. So I mean, look, the concept of trading baskets is nothing new. I think it was highlighted by some major market events like the crash of '87 and a few of those things that some of us here are old enough to remember. And I think it just shows that this industry has always been innovative in trying to deliver that product to the marketplace. How do you trade a basket of the S&P 500 as in the program trading issues that occurred back in '87 and other different market breaks over time? So, and if you look at it, it's been a really interesting progression. I mean, first we had funds, and then we've had index funds, and then we had baskets, and I too have been around since before we called them ETFs, right? We called them, in fact, the code name for the NASDAQ QQQ for that product was the NASDAQ Spider, because we didn't have anything else to call it, right? And people, so anyway, so I think it's been a great history, and it is just history of innovation, right? So index, and then active, and then asset classes such as, you know, fixed income, commodities, et cetera. So Rich, your very opening comments about the innovation and the rigor and the vitality of the U.S. capital markets, second to none. We do this, we innovate, we drive forward, we continue to move forward. And I think that's what this whole panel is about, right? This whole panel is going to be talking about what are the next steps that we see. And we could spend an entire hour just talking about the history. And but I do think the watchword is clearly innovation and continue to push the needle forward into delivering the right investment choices across the spectrum to the, you know, the investors of all shape and size. So I always look at it as a spectrum, right? You got, you know, individual investors, very conservative, one end of the spectrum, all the way to the most sophisticated day traders, and they all need a wrapper. They all need a product that delivers the different kinds of strategies. And so I think at the core of it. So anyway, I don't think I'd have much more to add, except that we built a great platform to launch into the future, and I'm really excited to hear what everybody else has to say today.
Yeah, that's great. And I think one of the things is as ETFs became a little bit more mainstream, we started looking at assets under management of ETFs versus mutual funds, compared the wrapper of the ETF wrapper to the mutual fund wrapper, and kind of put it as a a competition, active versus passive. Now we're moving more towards active and passive, not versus. And we're seeing mutual fund companies moving into the ETF space, the traditional mutual fund companies moving into ETF space. So that's changing the landscape a little bit, not just on assets under management, but on sort of product launches and things like that. So Reggie, why don't you start with you, and what are you seeing in that world now as these big mutual fund companies are moving into the industry, and where do you think that's going to take us, and how successful are they going to be as they try to adjust into the ETF space?
Well, I think with Vanguard's patent on their share class expiring, I think that more 40 Act companies are looking at having a dual share class in order to gauge a broader client set. And we're seeing a lot of conversation around that, whether or not regulators will approve it. But I think the pipeline is significant from the perspective of open-end U.S. mutual fund companies, 40 Act companies, are looking to launch ETFs, are looking to have share class, and also conversions of existing strategies like separate accounts or hedge funds or mutual funds into ETFs. And it really comes down to a couple of things. One, client preference. As we go through a turnover of investor cycles through passing down inheritances, the younger investors are looking for transparency and they're price sensitive. And then secondarily, ETFs, equity ETFs do provide a layer of tax efficiency, and that's also a primary concern. But also the financial intermediary are looking to build portfolios, and then active managers that provide alpha at a reasonable price are gaining significant market share. And I think we're seeing quite a bit of interest around that segment. So lo and behold, I think the long story short is that innovation continues, and the active manager is looking at fee compression and looking at overall complex costs and looking for ways to reduce their costs. And ETFs are a good avenue for consideration for that perspective.
Great, and I'll offer up to the other panels if they want to jump in on anything. But I think that the important thing that I heard there too really is a lot of the innovation is client driven. It's trying to do something that the clients want and need. It's not so much great ideas from certain people. It's about trying to build a better mousetrap for our clients. So gentlemen, again, I'll just see if anybody else wants to jump in there.
Yeah, I will, Rich, if you don't mind. I think Reggie hit it on this point, but I just want to amplify it. With respect to the large mutual fund companies who are now launching ETFs, a lot of it is driven by end client demand, but even more of it's driven by the financial intermediaries, the Morgan Stanleys, the Raymond James, companies like that, that offer asset allocation programs to their clients. And what those mutual fund companies have found is they've been losing business if they don't have a way to participate in those programs, because that's their main client base. So what's driving them is this is largely defensive from their point of view. They're just trying to maintain their existing clients as the clients migrate from mutual funds to ETFs. That being said, for all the reasons Reggie mentioned, it is a good thing for them. It allows them more portability, an ability to sell into distribution channels they haven't previously spent any time on. So you will see more of that. And it's mostly though driven by the fact that a lot of the old mutual fund asset allocation programs at large brokers are kind of giving way to ETF-based programs.
And I think that begs the question too, right? One of the advantages the mutual fund companies have is the 401k programs. So do any of you have a view too about ETFs having more and more traction into those 401k programs, or are they still sort of being shut out, or is it just going to be open to a few of the big players with the bigger ETFs that are going to be allowed in?
I mean, I'll take that one. It's a small drip in a big ocean for ETFs to jump the hurdles of the record keepers. If you tell me how someone's paid, I'll tell you how they behave. And from the perspective of record keepers, there isn't a fee-driven model that ETFs will deliver to the record keepers. And so that's one of the issues around plumbing. As the world goes closer to T+0, same day settlement, the settlement alignment will take away some of the friction that ETFs had initially caused with all equities selling T+3, now going T+2, going to T+1. Mutual funds effectively settled T+1, if you think about it. So there had to be some alignment towards the settlement cycle. When I first began offering market making services to the record keepers for ETF's inclusion, we were guaranteeing last night's price the following morning, plus some sort of commission to pay for the anticipated price difference between the two, and we couldn't charge enough. And so I think that's a perspective of like the market couldn't bear the true cost of that product. So we've seen some harmonization around it, but largely ETFs will not enter the 401k platform system in the United States anytime soon, wholesale, in my opinion.
Great, thank you.
If I could add to Reggie's point, managed index funds and having to deal with flows coming in the night before. You don't find out because of the way the processes work until the next morning. That's a huge risk. And you can manage that risk in certain fund structures like collective funds, but you can't in mutual funds. And you certainly can't in ETFs unless you go with brokerage windows as the vehicle. That adds a different complexity because not all 401k plans offer a brokerage window, or they don't like to offer it because they try to minimize the amount of trading. So I think these operational hurdles are real. It'll be interesting to see with the Vanguard dual class approach if that helps solve some of that problem. I haven't thought that through, but that's a possibility where you can see 401k participation.
Interesting. Thank you. So one of the things we keep seeing here, and it's mentioned a little bit too, is a little bit towards on the regulatory side, which is also always evolving and changing. We're going to have a few conversations around that today and a couple subjects. But Alex, I think in the indexing space, obviously we've seen a lot of innovation as we went from your traditional equally weighted indexes into smart beta, into commodities, and all these various things that we're doing now in the index space. So can you talk a little bit about what you see coming from the index space? I think it twofold for everybody, right? One is new technology coming in, and then the other side obviously is there's lots of conversations around the regulation around indexes and the role of indexes in the industry.
Sure. So I think that the short answer is, I think, well, first of all, regulation is here in Europe, certain markets. I think it's going to happen in the US. It's not, I would say, inevitable in the next year or 2 years. Right now, the SEC is effectively regulating through sanctions. That's their way that they could actually try to regulate index providers. But it's inevitable because if you look at the whole value chain in this world, the only portion of it that's not currently regulated are the index providers. And they operate under this guise of the publisher's exemption. And that was fine when you were publishing a broad-based index, measuring markets. But as indices have become much narrower based with thematics, smart beta, strategy indices, however you want to call it, more bespoke indices, that's very much on the regulators' radar now, right? Because now index providers are almost giving advice, and the power of the index providers in terms of making changes to indices is an issue. for regulators. So I think it's going to happen. It's a question, I think, of when and how they're going to go about it. I think in the end, it's actually positive for index providers. You know, I now sit on the board of CBOE, which is a regulated exchange, and you know, come to appreciate even more why people trade in the U.S. versus other markets, things like VIX and other products where you have liquidity, you have rule of law, you have regulation that's quite strong. That can only benefit the industry, right? I think you could see the same thing with index providers. If regulation comes, it's only going to help bring the industry up to the level that it should be. The big providers, the big index providers, they operate as if they're regulated now, but there's a lot of index providers that don't. I think that's the risk.
Yeah, and then to everybody else, right? But with this regulation, especially for a smaller provider, that comes at a tremendous amount of cost for them to become compliant, right? And then once they take those costs, does it make them less competitive? Does it make them less innovative now? Because now the challenge to innovate isn't there because they're spending all their time and money on the regulation side of it. So does that squelch innovation at some point into the indexing industry?
I think it's look. It depends on size of the organization. Indexing is definitely a scale business, and for any of the bigger providers, and I don't mean just the big three, but well down the list, regulation is the cost of doing business. Now, what people forget is, building indices is relatively easy, right? Effectively, if you have a spreadsheet, you can build an index. If you're smart, you can come up with interesting index concepts. Running an index business is very, very different. And the big ETF providers, the banks, that again, either other types of wrappers, they worry about the sustainability of their index providers because they're issuing regulated products. And so I think in the end, yes, there's going to be a cost to smaller providers. There's probably, in my opinion, too many index providers now. We're in the hundreds. There's no need to have that many providers. I think having, hundreds and hundreds of new indices come to market every year, I think that's great. That's innovation. But I don't think you necessarily need to have hundreds and hundreds of index providers to get to that level of innovation.
Great, thank you. And John, what about you on that concept, right? This innovation and competition. What have you seen? I mean, you've been in two different index shops. What are the changes that have you seen?
Yeah, so the changes I've seen are, I don't know that we need all these indexers, but I do know that the incumbent large indexers, and I'll include the old NASDAQ shop as well, just don't seem to be as fast and agile as the smaller shops can be, right? And I think that they're delivering strategies in the form of indexes and other mechanisms to the marketplace faster that the market participants, the investors, and the traders all want. I think the large shops then look at that and say, okay, see what works, and then come out with a version that fits in their family, et cetera. So I do think it's important. I mean, Rich, you go back in time, the reason we formed ETF Build to begin with is because the oligarchy in indexing and the oligarchy in asset management in the ETF space kind of, it was driving the conversation, and our whole point in creating this was let's surface issues that won't get the light of day too often. So I'm a firm believer in the competition, but I do think that it's creating this environment that Alex, as you pointed out, where the SEC wants to start regulating indexers, and they've tried it in multiple ways in the past because it's no longer publishing the S&P 500 and the NASDAQ 100 and a few broad-based indexes like that. It is now bespoke indexes that are done for a single client that gets or self-indexed and gets the captive data and those kinds of things, and that's really something that they're concerned about. So anyway, I don't know the answer, but I do know that I do think that with any oligopoly, and that comes from my exchange past too, the startups and the other smaller players are faster, nimbler, and will deliver more innovation to the marketplace. And I think that's a good thing. So I do believe in the competition, but where the balance is, I mean, can we afford to have hundreds of little indexers out there? That's just going to beg the SEC to walk in and kind of put standards in place.
If I could add one thing to what John was saying in terms of innovation and the big providers, some of it's just a function of math, right? So you look at the big three, they're all north of $1 billion, $2 billion, $3 billion in revenue now per year. So what does it take to move the needle for them? Their business now needs to focus much more on supporting products that are in the marketplace than building new products. And the reason is that you license a new product that gets $1 billion in assets, a new ETF, for example. First of all, that's going to take you a couple of years to get to that level if you're successful. You're making $200,000, $150,000, maybe $300,000 in revenue from that. For a small provider, that's a lot of money. For an MSCI or an S&P, that's not. You know, they've got to generate, $80 million a year in new revenue each year just to maintain the growth rates. And so for them, their business models have to evolve. And that does open up for what I would call second-tier index providers that can be more nimble, that can make money on smaller mandates that just may not be worth the time for the big providers. Which is why I don't think, as John pointed out, you're seeing the big providers being as innovative as they could be, even though they have the resources.
Thanks. And Ira, what about from your perspective, right? You helped launch one of the biggest ETF shops ever. You're continuing to look at new innovative firms coming into the marketplace and trying to help them. What are you seeing as their struggles as they're trying to launch new products into a very competitive marketplace?
The dynamic that Alex and John, I think, very perceptively laid out with respect to the index providers is very similar when you look at the ETF sponsors. First of all, depending on how you look at the numbers and what you think of as the ETF industry, no matter how you cut it, it's very concentrated. The three largest players, BlackRock, Vanguard, and State Street, control something north of 80% of the assets. Again, depending on how you want to cut the numbers. They have for a long time. There's every likelihood that they will continue to do so for a long time. They're generally mature businesses that are interested in generating as much scale and profitability as they can, rather than focusing on innovating. To them, it's not that they're against innovation, but innovative products, they're not usually big enough to drive their profitability in a significant way. So they view innovation more as a threat that they have to sort of think about rather than an opportunity. And as Alex or John mentioned, in the index space, the ETF providers do the same thing. They are unlikely to be the people who lead innovation, but they look very closely about what is catching on. And if something's catching on, they will try and be quick to launch their own version of it and try and take as much of the flow going into that new innovative category as they can. I mean, a good example of this, and I know we're going to talk about this more later, is Bitcoin ETFs, where as the grayscale litigation progressed, you saw a lot of other providers, including BlackRock, file their own versions of a product that they can have ready to compete with Grayscale if and when Grayscale ever gets regulatory approval. So what the BlackRocks and the State Streets want is not to let a nimble, innovative provider jump too far ahead of them. And as long as they can do that, they will continue to get the benefits of scale and size and being a mature business with existing client relationships and try and drive profitability through that. So they're not anti-innovation, but they're not going to lead it. as John indicated in the index space, the innovation comes from new players who are more interested in carving out a niche where they can get a little bit of market share. They're the people who are most likely to take a bet on a new product that may or may not succeed. And some of them are successful. The challenge, though, is, if you only have one or two products like that, it's hard to create a sustainable business. So what you see is the same dynamic in the index space where people who are successful with one or two products make a successful business, but it's ultimately not a scalable business. And some of them will get bought out and absorbed by larger players over time as the industry consolidates. But the other thing I just would say quickly is we are used to sort of thinking about the ETF landscape as a one big business where everyone's competing with everybody. And that's really not the case as the business has matured. ETFs are maybe one way to think about them is that they're a kind of wrapper that competes with mutual funds or other kinds of collective vehicles. But within the people who are using ETFs as wrappers, they have different business strategies and different targeted client segments, and some of them are not really competing directly with each other. So, as an example, Capital Group, which is one of the largest mutual fund players, has now launched its own ETF business. They're really not trying to take market share from State Street's passive ETFs. I mean, if they do it, that's great. But what they're trying to do is find a way of delivering their own asset management capability in an ETF wrapper to exactly the same kind of clients who've traditionally bought their mutual funds, but now want to access it through ETF wrap programs at various intermediaries. So it's a different business model than the business model that John created, for the QQQ or things like that. And we just have to be conscious of that it's not one single industry. It's a bunch of market segments that are somewhat competitive with each other, but not entirely. To some extent, the competition's within particular market segments.
Yeah, and that brings us to a really interesting point too, about the changes in the industry and where it's moving to, right? So a number of years ago when we were launching ETFs, we said the biggest three problems in the industry was education, education, education. Today, the biggest issue is distribution, 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 right? This is how people are going to, compete. This is how they're going to become profitable. And those strategies are changing dramatically. And Reggie, are you seeing anything from your desk in the way providers are trying to sell their ETFs and who they're selling them to? And I know there's a whole other conversation around the seed capital and launching ETFs that have changed over the years as well, and where that may be going. But what are you seeing in that distribution model that's coming out?
Well, I think at the top of the house, ETF models is a indirect grand way to distribute individual ETFs that are wrapped up into a larger model, and that segment is growing tremendously. So you need to have a complex in order to create those models and to be successful. I think from the perspective of just pockets of success are around thematic, the flavor of the day. And there's a lot of investor demand around flavor of the day, and they come in and go out. But largely, it's really a ground game. You've got to get into the home market, the home offices, get approved on the platforms, and you get inside of advisors as they're thinking about client-centric issues about building portfolios and then meeting the areas of need. So really, distribution is really multifaceted, complex. It's gone digital. It's not just boots on the ground. I think COVID has changed some of the mindset around advisors, how they want to be engaged directly. but ETFs are sold, not bought. And without effective distribution, without effective education on the ground, and particularly how new ETFs are used, there's a lot of disadvantages for a new ETF issuer not understanding that mindset and the framework of how they're distributed.
Great, thank you. Anybody else have any thoughts there too about what's happening in that space? And maybe that also leads us into, as you mentioned, client-centric. You have a wrapper that satisfies everybody's need if you have a strategy. So as much as ETF models are making great headway in the marketplace, so is direct indexing. And I don't know if any of you all have a view on where direct indexing is going.
Well, I'm not sure.
And how that's helping providers.
Yeah, I'll jump in there. I'm not quite sure. I mean, there was a Knights article this past week talking about advisors complaining about the number of positions in their portfolios around direct indexing. Look, it's nothing new. Direct indexing has been around for a long time. It's really about tax optimization. And then particularly now around investors' desire around ESG concerns or just social issues where there could be some sort of limitations around a policy benchmark not having exposure to a certain segment or desirability. But I think this whole grand scheme was really around how can the platforms, i.e. Schwab, Fidelity, and others, charge more or earn a higher revenue stream around something that is already wrapped up into an ETF. So I think it's muted, as far as it being new. It's been around. It's just now in a different marketing package and a little bit of a bullhorn talking about how great it is.
But if I could add to what you just said, I think one of the issues, as you pointed out, right, so with direct indexing, which I think is a misnomer, because by definition, you move further and further away from an index. It may be your starting spot, but you look at the way it's positioned now, almost all of it is this tax harvesting, which lasts only for a certain amount of time. Because at a certain point, and there's been plenty of studies that have shown this, you lose that tax alpha that exists. And we've lived through, you live through a growth market. At some point, every tax lot you have in your portfolio is at a gain, which means you can't harvest it anymore. Harvest it. Why are you paying that incremental fee to this point? The issue around choice is much more complicated. Everybody likes the concept of being able to modify their index or their portfolio the way they see fit. Problem is, when you actually have to go to make those choices, it's a lot harder. And most people then fall back to, well, give me something that looks like NASDAQ 100 or the S&P 500, right? People, it's hard for advisors to actually make those changes at what I would call the retail wealth level. Institutionally, it's very, very different, right? Where you want to start excluding particular issues. Much in the same way that ESG in general in the US has had a lot harder road than it has in Europe, because deep down people say, oh yeah, these are great concepts, we want to do well, but now you expect me to make those choices. And I, as an investor, don't know what those choices are. If you give people too many choices, you end up becoming like a deer in headlights. And that's one of the problems that I think is happening with some of this direct indexing. And if you look, again, most of these assets are just that. It's tax harvesting, much more so than the modification of the index.
Great, thank you. And let's get into this bigger conversation now that's prevalent in the marketplace around Bitcoin, right? And this is really where you look at the innovation of the ETF industry, and how it's developed over time. And we've taken various asset classes and have innovated our structure in a way that we can bring those asset classes to investors in an easy and cheap format, right? You go back to commodities, fixed income, all those innovation over the years that we're seeing every day in our ETF products. So the newest one that's out there now is the cryptocurrencies, and it's Bitcoin. And it's been a long struggle with the regulators. It's a long struggle understanding how Bitcoin actually works, and the trading around Bitcoin. So John, why don't we just start with you in terms of your view about all the Bitcoin filings, where we're going with this, and are these products ever going to come to market?
Yeah, we've definitely touched upon this multiple times. So just a little background. In 2015, I was still at NASDAQ, and NASDAQ was supporting Tyler and Cameron Winklevoss and Winklevoss Capital as they wanted to move forward with a Bitcoin ETF back in 2015. And Kathleen Moriarty was outside counsel. We went down there with the Bank of New York, Tyler and Cameron. We met with probably 40 people at the SEC, spent hours and hours and hours, and there was zero understanding of the product, Bitcoin, zero understanding, and even less enthusiasm for it. And that was 8 years ago. And but the market is demanding ways to invest in these products other than buying the Bitcoin directly. And the industry has innovated, obviously, by Grayscale creating a mutual fund and the futures ETFs and every other way you can look at this. People are doing it, and the SEC is continuing getting boxed into a corner, I think, because they keep approving little pieces on the edge here and there, including the Grayscale mutual fund is a 40 Act fund, and the futures-based ETFs and other filings. So it's hard for them to not eventually make this, allow this to happen. And so I think Ira made a great point. Grayscale innovated. They got the fund out there, great size, and filed to convert it to an ETF. And then others are doing that as well. There's room for a lot of people to bring products in the marketplace. And one of the points Ira mentioned, which I think, he hit very lightly, and to their credit, BlackRock has phenomenal distribution to their existing client base, right? So when BlackRock brings that product out, others may have brought a product out, but when BlackRock brings it out, their customer base is going to look at it. They're going to say, I got 5 different products to look at, but I'm familiar, I trust, I believe in BlackRock, I'm going to do it. That's why people are bringing their products out. So I believe that with the recent court case, that we are going to see Bitcoin spot ETF hit the marketplace. It's going to, and then I believe, and whether or not the SEC says, Grayscale, tweak your filing to make it conform with everybody else, and we'll approve them all at once, or we'll do it one at a time. They're all going to happen in short order, but I do think it's going to open the door. And I also think Bitcoin is probably one of the most controversial cryptos out there because of its history and everything else. And but I do think, and we've all seen the first filing, I think, on Ether, et cetera. We're going to see more of these come through the portal and hit my product. So I think you'll see other products. So long story short, I do believe the SEC, the path is that the SEC, whether they want to or not, is going to have to approve a spot Bitcoin ETF, and several of them are going to hit the marketplace. And I think that's just going to open the door to that asset class once and for all. So.
Great. Ira, investor, you guys want to jump in?
I will if you allow it. So I think I'm the only lawyer on the panel. I'm going to give a slightly legal regulatory take on what's going on with the Grayscale court case. Just for 2 seconds of background, the relevant law is that the SEC has authority to approve rule changes from stock exchanges. And they have to do so as long as the rule change is consistent with the requirements of the securities laws. That's the only statutory authority at issue here. The SEC has historically said that when you list a product on a stock exchange, that is a rule change that has to go through a regulatory process at the SEC. And because it is technically a rulemaking by the SEC, that has to comply with general standards that the SEC not approve or disapprove products in an arbitrary and capricious manner. That's the legal requirement. The problem here is that ever since I've been involved in this industry, the SEC has used that ability to approve new listings of ETFs as its primary way of blocking new products from coming to market. And it's been nothing but arbitrary and capricious. The entire regulatory edifice that the SEC has built around this statutory provision is bizarre and illogical, and the more you look at it, the stranger it is. And the court only looked at one little piece of this. What they said is that the SEC was trying to distinguish between Bitcoin ETFs that are based on futures and Bitcoin ETFs that are based on spot markets. And the SEC approved futures-based products because in their mind, they could look at the futures markets, which are regulated, and determine that there was no manipulation going on in the underlying market. But they refused to take the same view with regard to Bitcoin based on spot. And the court said the futures market and the spot market are so intertwined that that's ridiculous. Go think about this again, SEC. And that's just one way in which the rules are arbitrary and capricious. There's 100 others I could name. The most egregious in my mind is that you can list a closed-end fund that holds anything you want, because closed-end funds aren't even subject to this process at all, despite the fact that they're, quote, listed on a stock exchange. It's just a bizarre distinction the SEC has always made. It has no basis in logic. So I think, with all that said, the SEC is very vulnerable if people want to take them to court on these kinds of issues the way Grayscale did. Grayscale is the first one, to my knowledge, that's ever done this. And the reason is generally people don't have an economic incentive to pay the cost of litigation and getting adverse with the SEC. In this case, the economics were big enough for Grayscale. They took the risk. And so far, it's paying off for them, at least that they won the initial litigation. But you may see more people try it now that there's courts clearly looking at the way the SEC is applying this particular statutory authority. And the SEC is vulnerable. And if you do see more people challenge it, the thought might be that that will lead to more innovation. And I guess my thought is it will actually not. It will be the opposite. What you will see over time, if the SEC is challenged more, is they will just say no to everything. And therefore, they won't create the problem that they have in the Bitcoin litigation because they approved one thing and not another. If they just said no to it all, they would not be as vulnerable. And I think the way the regulatory mind works, that's where they're going to wind up. So I think innovation may become more difficult if people challenge the SEC more.
Great. Reggie, Alex, and you guys want to thoughts?
I'll just add one thing on Bitcoin, which is, again, as things evolve quickly. So I mentioned I'm on the board of CBOE. They actually have the first fully regulated spot exchange that trades both spot and just got approval for futures, also levered futures on spot. So very different than CME's product. So it'll be interesting to see because one of the arguments, as was mentioned, was that you can't trust these trading platforms for Bitcoin because they're not regulated. Coinbase claims they're somewhat regulated. They really aren't. They basically have a money transfer license. They're not really regulated as the way traditional exchange is. Well, that's now changed, right? So it'll be interesting to see if somebody wants to use. I'm not trying to say go use CBOE's pricing or trade on CBOE by any means, but you now have a traditional exchange that owns a fully regulated spot market that the SEC is aware of and was happy that we bought SEX. If they start using that as the basis for these products, they lose that argument that the surveillance and the manipulation, at least in terms of a platform that's under their regulation.
Great, thank you. We have about 10 minutes left. I don't see any questions coming through.
No, there's a couple in there. One of them was about
I'm not seeing any of them, so thank you, Reggie.
Yeah, what's the most innovative product or strategy or witness or been able to create? Like what's coming down the pipeline? Like what's been interesting? Um, I'll just jump in. I think what I think is happening in the future is the use of derivatives inside of the exchange traded product structure, whether it's the defined outcome, quote unquote, or it's limiting some sort of downside protection or putting alpha into a product. You look at a JP Morgan product, they've had great yield using options. I think that's there's more whiteboard uh, to cover in new product development, particularly around that. I think that it takes a derivative expert to do it. So he's not necessarily going to, I mean, it's regulation around that. So you're not going to have, I think, a wholesale people jumping into that, people being firms jumping into that because it takes expertise to understand it and to do it well. But I think the marketplace is starting to understand it. The issue you have with those type of products is that you have, they're not simple, straightforward, and they're complex. And so education suitability needs to be at the forefront here. And I think that is just a clarion call largely around complexity that these little wrappers here, they dance around the screen, but they're all different. And you need a package of diligence to understand how best to utilize them. We've seen that with litigation around leverage products and suitability concerns around folks who are retired. And I think that you'll see this more as derivatives start to take shape inside these structures. So I think that's where we're heading, where there'll be a lot more innovation around that, particularly around derivatives and fixed income and or corporate bonds. There's lots to think about, in my opinion, around that. And then one last thing to also just to state, when you use derivatives or anything other than equities inside these structures, the tax efficiency starts to diminish. And so you have to put that into your product development set and then make sure your marketing materials are in line to the reality of just proposed outcomes. And so you can't forecast something that's not going to happen. And you have to think about the depth of the marketplace and then the size and capacity of these structures as you distribute and launch them around those concerns, future-based issues, role issues of futures inside these structures have all been prevalent over the last 15 or 20 years.
Interesting. Thank you, Reggie. Yeah, and Alex, John, and Ira, go to you guys each separately to take just a few minutes and talk about what are you seeing in the future in terms of innovation. I know there's a lot to talk about AI and other technologies, but what do you think is going to shape the industry of the future? So start with you, Alex.
So one thing that I think sometimes people forget or fail to realize is the depth of liquidity of the U.S. markets is so great that there's so much of the growth in the U.S. is actually coming from offshore users, right? And that's something that people, in the industry are always wondering, when will Europe, growth of ETFs grow in Europe and in Asia? And that will happen, I think. But I think it's a testament to liquidity, the rule of law that exists in the U.S. market, that you could be sitting in Japan and go on your PC now and you could access US ETFs. And that's a huge advantage. And so I think, it's bad for exchanges and people that want to create local product. And there's some reason why you need to have some local product for other distribution requirements. And I think that's sometimes underestimated in terms of the growth potential of the US market. And so from an ETF issuer, thinking globally, it's a huge opportunity still ahead. And again, the big players, they understand that they're out there. But I think that's an opportunity for all the second-tier ETF providers. Pick your spots and find markets where you can partner with somebody maybe that has local distribution. Not all the products have to be traded, in Singapore. A lot of those investors want the exposure through U.S. marketplaces.
Interesting. John?
So I think two big things are going to occur. I think the mutual fund conversion, I think you're going to see that accelerate. So I think we're going to see bigger and bigger mutual fund families, complexes get into the ETF space. I think Kodak's, there's a huge still runway to go with exchange traded products. And secondly, I do think AI, I've been doing, talking about this at Georgetown in some professional classes there about the role of AI in the future of the financial services industry in general. And as this gets refined and the tools get better and better and better, I can see where it will be, for the right innovative firm, a great supplement. It's like in education where done right, like the Khan Academy is doing, you can start providing one-on-one tutors in the Socratic method, et cetera, to students, et cetera. There's great tools there. Same thing, you'll be able to, through AI, provide tools to investors and traders to help them really work through all the things that are out there and integrate and come up with a really good idea of what they should be looking at and how they should be looking at their portfolio. It's not going to replace advisors. It's not going to certainly replace firms, but I do think if done right, it's going to be a great tool to help them. And like, there's no human today that can go through every single product, every single strategy, incorporate the tax strategies and the tax implications, all that kind of stuff. It's not going to happen. But with AI as a tool supporting that, I think you're going to see a much better job of delivering those kinds of strategies and those kinds of tactics to the marketplace. And I think that will probably start to give smaller products or niche products more exposure and so on. So anyway, I think AI is going to revolutionize, not today, not tomorrow, but very soon. It's going to really revolutionize financial services in general. So to me, it's mutual funds coming in addition to what we talked about, mutual fund complexes coming in a much larger way. And secondly, AI.
Great. Thanks, John. And Ira?
So I agree with what everyone has said, but the theme I'll highlight for the next decade or so is I think you're going to see more of a focus on development in fixed income than you have historically, and that fixed income ETFs are going to evolve significantly. Fixed income ETFs are sort of a weird thing. Indexing doesn't work as well in fixed income space, or at least as people have historically thought about it. And ETFs are an equity-based product, and the people who make them generally come from equity backgrounds. So fixed income ETFs are definitely a specialized niche. They're harder to do. There's a lot of technical issues. They just don't trade like bonds trade. That being said, they have a lot of benefits if you can come up with the right product, because the bond market has become increasingly difficult to trade in size, but you can trade a liquid ETF very easily and at much less cost than certain bond asset classes. And I think as people recognize that that's a relatively underpenetrated area for ETFs, you will see more focus on building better products for that market that suit the end customer's needs better, and more time spent educating users of fixed income on how to trade ETFs, because that's actually one of the largest obstacles. They trade very differently. But I do think over the next decade, fixed income will be a larger share of the ETF market than it is today.
Great, thank you. And Reg, you have anything else you wanted to add? I know you're answering the question that kind of also answered the innovative question, but just give you a moment if you have something else you wanted to add.
No, I agree. I mean, fixed income is where it's at. ETFs have revolutionized that market structure and will continue to do so, bring lit transparency into corporate bonds. And the corporate bond market is just enormous when compared to equity markets. So there's lots to think about around indexing of the entire corporate bond space, and then bringing transparency around price discovery. So ETFs are a part of that cycle. And we have a lot of seasonality around just exposure to that asset class. So I agree with what Ira's saying.
Right. Well, we're at our time limit, and again, to all the panelists, Alex, John, Ira, Reggie, thank you so much for your time and your expertise and sharing it all with everybody. Greatly appreciated. Everybody, thank you for joining us and listening to our discussion. Hopefully, you picked up some things for it. And innovation is what created this industry, and it's going to continue to lead this industry forward for, as Ira said, many decades to come. So thank you all, and we'll see you at the next ETF Build webinar. Thanks again. Have a great day.